morning, everybody. Hope everybody's having a great morning today. My name is Diezel, and I'm honored to be here today to kick off IMN's Multifamily Middle Market Forum. I'm a senior real estate industry analyst and senior manager at RSM. I am headquartered here in Chicago, we are, and we're the leading provider of services to middle market firms, providing advisory, tax, and consulting services. So setting the table, 10 years ago today, Americans were in the midst of losing $10.2 trillion as a result of the stock market crash and related recession. A decade later, are we gearing up for a repeat? All signals in our current market are that we will continue to have strong fundamental performance, especially in multifamily. But we should probably take heed. It's more important now than ever to make sure we're making the right picks, as arguably we're probably closer to the end than we are at the beginning of this cycle. There are warning signs. Higher credit costs will make borrowing more costly. We all know how the administration feels about the continued rise in interest rates. Inflation will make input costs, which are critical in development, like natural resources, energy, and labor, more expensive. We've been enjoying a really robust recovery, most recently sustained by solid GDP growth, bolstered by the Tax Cuts and Jobs Act. These effects will start wearing off by the end of 2019. And unless there's further cuts, will GDP continue at the current rates? There's that other pesky thing, that trade war with China. The administration just hinted today that there could be even more tariffs on top of the already $250 billion that have been imposed. Our deal with NAFTA, the USMCA, really didn't change anything fundamentally and left out one really important item, those steel tariffs. So even if we continue to isolate the pain we're feeling now for a bit, what does that mean for where we're at in the cycle? Other issues, labor markets are tight. Administration's been focusing on restrictive immigration laws, which aren't helping. There appears to be a mismatch between wage growth rates and the rate at which housing costs have risen. In addition to focusing on these key market conditions and macroeconomic factors affecting our outlook, there's also one demographic that we continue to follow as real estate investors, and I bet you probably can guess it, those millennials. So they're about to surpass the baby boomers as the nation's largest living adult generation, according to the U.S. Census Bureau. So it probably makes sense to continue following their preferences. Surprisingly, in Chicago, we have 3 of our zip codes are in the top 20 in the USA for population density of millennials. Where do you think they all live? 73% of them are living in the West Loop. 61% and 60% respectively are making up the demographics of River North and Goose Island. So certainly their preferences will come into play. So we'll talk about these items today with our esteemed panelists, and I'll have them introduce themselves.
Good morning. My name is Jim Driscoll, Senior Vice President with Waypoint Residential.
Good morning, everyone. My name is Mueller. I'm the Vice President of Acquisitions and Finance at Pensam Capital out of Miami, so please don't beat me for last night's game.
I am Glenn Miller, and I'm a professor at the University of Denver. Our real estate and construction management program, second oldest in the country, and we're also the real estate investment strategist at Black Creek Group out of Denver.
My name is Domonic Purviance. I'm a financial specialist at the Federal Reserve Bank in Atlanta, and my focus is on residential real estate. I have to give a disclaimer. My views do not necessarily represent the views of the Board of Governors or the Federal Reserve Bank of Atlanta. They are my views. Sorry.
All right, excellent. Now I'd like to hand it actually over to Glenn, who's going to take us through a couple slides to illustrate where we're at in the cycle.
Okay, well, good morning, everybody. For the last 25 years, I've been producing a real estate market cycle report, and that will be available to you here at the conference. It's also going to be on our University of Denver website here in just a few weeks, so you'll be able to pick it up there. And I've been basically modeling real estate demand and supply, occupancies, rents in the 5 major property types. So today, obviously, I'm going to focus on multifamily. To me, real estate is just a delayed mirror of the economy, and employment growth is what drives demand for all the property types, including that rate of growth is decelerating, and it's really just a demographic thing because the number of baby boomers who are employed like me are starting to retire, and the rate of that retirement is starting to rise now as we get towards the peak of baby boomers. And the rate of growth for millennials, which has been strong, is starting to slow down a little bit, so that marginal growth rate between the two is starting to move. So you see employment growth, the blue line there, decelerating down to close to zero for about a year or two in 2021, 2022, and then picking back up again. But overlaid on that, the gray bars, you can see that total employment doesn't actually decline. It just flattens out for a few years and then picks up again. So from that standpoint, demand continues to be good and strong. So as I say, I model the 5 major property types, and here they are, the sub-property types. Basically, everything except apartments is in the growth phase of the cycle. We have more demand than supply in all the property types. Apartments is the one property type that's a little over the top, and it's not because of bad demand. It's because we're actually putting up supply at a slightly higher rate than we have demand growth. So we've got a 2+% demand growth, but supply is growing at 2 3/4. So we're just about it's just over the top into what I call the hyper supply phase. So let's look here at this history, and you can see occupancy rates all the way back to the 1980s being high, dropping down during the Great Recession of 1990, peaking again in 2000 during the technology boom, dropping off during the technology crash, coming back up, not to kind of the long-term average level there, obviously bottoming out during the Great Recession, picking up, and we actually peaked occupancy back in 2014 in apartments, and because of this extra supply, you can see it starting to slow down and come down a little bit. We're only talking, a 0.5 to 1% here, so it's a very small number, but you can see rent growth therefore decelerating and eventually going negative a little bit, as when you've got too much of anything, what do? You drop the price so that you can sell it. So we're in just a little bit of an oversupply. If I could, for the developers in the room, if we could cut back on new supply by about 20%, we'd bring the whole market right back into equilibrium, and things would be fine. So just back off a little bit, okay? So here we are in the cycle, and you can see that we do have a number of cities that are at their peak, which is equilibrium, demand and supply growing at the exact same rate at 0.11 there. And then I highlighted Chicago because that's where we are today, just a little over the top. Other cities having a little bit more supply than demand out there. Okay, and I do a forecast report as well, and pretty much everything looks the same. A few cities moving a little farther just because of what's actually in construction right now that's moving up. In Chicago, you can see moves from 0.12 to 0.13 as we finish off a lot of space that's coming up. We'll end up talking in the panel about, a lot of it's been downtown core new construction that's now seems to be moving out to the suburbs as well. So we'll kind of analyze that here in the panel. And of course, basically demand and supply drives occupancies and rents, and that's the income side of things. If we look at the pricing of real estate, what we see here is, this is from Real Capital Analytics, a firm out of New York, and if you ever get a call asking to confirm information on a property you bought or sold, please do so. They started collecting data on every single real estate transaction in the United States, over $2.5 million back in the year 2000. And so you can see transaction volume going from 20 billion to 160, back down to 15 billion during the Great Recession, and hitting another 160 billion back in 2015. And then they run, if you haven't seen this, you should be watching it. It's called the Moody's Real CPPI Index, Moody's Real Estate Commercial Property Price Index. It's basically the same thing as the Case-Shiller Home Price Index. The nice thing is they do it by property type and by market as well. So you can see here that we are currently pricing all real estate 23% higher than the previous peak of 2007. Apartments are 62% higher than back in 2007 already, so 62% appreciation. Followed by retail, hasn't quite got there. Industrial 16% higher higher, CBD office is 29% higher, and suburban 2% higher. So apartments is one. From a pricing standpoint, you've seen a lot of good price appreciation there. So with that, I will turn it back and we'll continue.
All right, thank you so much, Norm. That's really helpful in terms of setting us up. So where do we think, to kick it off, what's been the impact of single-family rentals on the multifamily market?
Sure, I'll start that, at least from our perspective, what we see in the market. I think it really goes down to the pocket you're in and the submarket you're in, even the city you're in. The best two examples is in our portfolio, we own deals in Fort Worth, Texas, and we own deals in Denver, Colorado. In Fort Worth, the home ownership is, actually the median home price is about $150,000. In Denver, the median home price is about $450,000. So in Fort Worth, people can easily rent single-family homes that compete with our apartments. In Denver, it's a lot more expensive for people to rent single-family homes. In Denver, it's going to cost them $2,000 to $2,500 to rent a single-family home. In Fort Worth, it's going to cost them $800. Well, if our apartment rents are $1,000 in Fort Worth, they might select the $800 home. And if our rents are $1,500 in Denver, they're going to select the $1,500 rent rather than the $2,000 to $2,500 single-family home rent. So I think that you're starting to see a lot of single-family home rentals hit the market, especially the Starwoods, imitation homes that own 80,000 single-family homes. I know there are some investors in the audience tonight that own single-family homes and they've built a business off it. It is something we need to be aware of as apartment owners. But again, if you're in a market, I think, where ownership is so expensive, you should be okay being in the apartment business.
And I'd say that, in essence, the whole single-family home rental thing really just added to this supply of, rental, of residential rental over time. And so that extra supply was kind of, you don't even have to build it, you can buy it, out of single-family home ownership into rental, which was what I did with my three sons back in 08. We started buying foreclosures. And first one paid $180,000 for it. The home prices have gone through the roof. Just sold it for $420,000 as a home ownership, and so it's out of so it just went out of the rental market because it more than doubled in value over time. So we're literally selling out of our single-family home rental just because the housing prices have gone through the roof in Denver.
And I'll just add, so single-family rentals are not new. They've always been a part of the rental supply. They've just been primarily owned by the mom and pop investors that own 2 or 3 properties. The only difference now is we've seen since the downturn and increase in institutional investors that own a portfolio of properties. But the largest institutional investor, I think, is maybe Blackstone. They may own maybe about 60,000 units nationally, something like that. And so, and it's scattered across the country, so it's really, to me, it's not a significant part of supply unless it's a specific submarket.
Right. Actually, and when it first started, everyone assumed that it was going to be we're buying these things at foreclosure sale prices, and once they appreciate back to normal, we're going to sell up and run, because actually renting single-family homes is a lot harder than renting 200 single-family homes versus a 200-unit apartment building is a lot harder. But with some very bright people, they've figured that out and got economics to the point where they can do it. The one thing I'll say is the millennial generation is still not as interested in home ownership as my generation was, saying, okay, I did just have my first kid, and we just had our first baby, and you've heard the term balcony baby. Taking the kid outside on the balcony isn't working, so we need a yard, but I still don't want to buy. So there is a good demand profile for these single-family homes, getting that to either in town or out in the suburbs where they've got a yard for the kids.
Yeah, and there's actually a couple national developers who now in some of the Sunbelt markets are building build-for-rent communities, so single-family homes, in some cases courtyard homes or townhomes. And what they're doing is they're appealing to that millennial generation who may not want to continue, who may not want to own a home, but they want to continue to rent instead. The other thing that Noah talked about, about the price differential of ownership versus renting, Certainly, markets like the Mid-Atlantic and Northeast are markets where if you chose to pick a single-family rental instead of an apartment, you find a significant price differential. So one of the things that we're looking at with Waypoint Residential is the idea of rental townhomes. And they could be traditional townhomes, or in more cases, higher density townhomes. One of the things you talked about with balcony babies. The other analogy I use is, it's hard to push Johnny down the carpeted corridor as they will. And if you have the opportunity to have a small driveway, a small yard, then you give the opportunity for a family to continue to grow in a rental environment.
So it looks like those millennials continue to shape our considerations here as we go further into the cycle. So moving on to the next topic, what do you all see as the impact of tax reform and increasing tariffs on the multifamily market?
So tax reform, capping interest rates, or capping the interest rate deduction, I guess is a better way to put it, I think severely impacts extremely wealthy homes and any high housing price area. That's just one more reason why a millennial doesn't want to buy a house, because the interest rate deduction is going to be there, and this overall deduction being higher, again, it decreases the motivation for them to want to own a home. So I think that bodes really well for apartment.
One thing I would add to that is just specifically on the tax cuts. When we saw the tax cuts, we saw an immediate positive outlook, or we saw positive feedback immediately from our tenants. The reason being is a lot of these tenants are working class people, and they got a $25, $50, or $100 pay increase immediately overnight. Well, that's a big deal for renters. I mean, we specialize in the middle markets, in the suburban areas. We're not in the downtown high rises where millennials throw money away like it's nothing. We really focus on those who $25, $50, $100 is a lot of money. So to them, have that extra money in their pocket is big, and a lot of those people decided to use that money to either move to a larger apartment, so go from a 2-bedroom to a 3-bedroom. Maybe they had a child or two and they want additional space, or they decided to say, we have additional $50 every 2 weeks in our paycheck. Why don't we go for an upgraded apartment? And that was huge for us. There are a lot of investors out there who keep playing by this value-add program, and that's their business model. That's how they grow rents. Those investors saw immediate impact from that. Now, on the tariffs, it's a little bit different. I think that we're starting to see some impacts on tariffs. I will tell you that our portfolio specifically, as value-add buyers, we have seen an increasing cost to our renovations. Now, we have 15,000 units across the country. We have a lot of different suppliers, so it's not as bad for us. We have 10 different suppliers. We can always move around, especially if those suppliers aren't from China or other countries. So there are certain investors and groups out there who specifically use, get granite from China. Those costs have increased 40% over the last 3 months. That's going to be a real question now in the boardrooms of those organizations as to whether or not they want to continue to spend money on upgrades. So again, I think we're not sure where that's going yet and what's going to happen, but I guarantee it's going to be a talking point over the next 3 to 6 months until either a solution is found or they decide what their return profile looks like.
So is it currently just squeezing your margins, or are you actually trying to pass along those higher rents to the tenants?
Well, I would say that, again, for us, we're in a little bit different situation. We're a pretty massive organization. We have 10 different suppliers to work with, so although we don't like to cut out suppliers, if we need to, we can. So for us, we know that our tenants cannot pay more than, let's say, $150. So if it costs us 40% more, we can't charge our tenants 40% more. There's a ceiling to what they can pay. Again, these are suburban Class B properties. If you go to downtown Chicago, millennials who are making $100,000 a year, they'll happily spend an additional 30%. They're a little bit ignorant, I think, to the world of what it costs. So I guess it depends on who your renter is.
On the development side, we're currently projecting a 6% hard cost inflator on a year-over-year basis, and it's kind of the model we're doing right now.
So it seems like those tariffs are starting to show up in the data points and will be a consideration residential, senior living, student housing?
Waypoint residential, we're actually in all three spaces. So we, much like Noah, we focus on mostly suburban product. Not that we don't think the urban product is cool, but for us, the reality is that 75% of the country lives in suburban locations, and the institutional capital has tended to err toward the urban locations. It's bigger about the urban, TOD, millennial, hipster locations, and while, as I said, well, that's cool, 75% of people live in traditional 3-4-story wood frame with surface park or attached garage buildings, and so that's really the area of focus that we have. If you look at it from a price point perspective, we focus on the bottom 25% of the renter by choice, top 25% of the renter by need. And so we're looking at MSAs around the country where there's good household formation, good job growth, and where people can rent for 30% of median income. And we know when we look at some of the urban markets, people are paying 40, 50+% of median income. The reality is that's probably not them, it's probably them plus their parents or their grandparents. And we don't think it's a sustainable model. On the student housing side, we continue to focus on the locations that have strong state flagship universities. As incomes continue to rise more slowly than the cost of education, we believe more and more people will choose the better state flagship schools as a more cost-conscious alternative. And as a result of having that savings as compared to private school, they'll likely have the ability to then fund that private housing solution for their children. And then on the senior housing space side, for senior housing for us, that means the traditional independent living, assisted living, memory care space. Like the discussion before that Glenn had about the supply of multifamily, there are an oversupply of senior housing in certain markets as well. People are starting to gear up for a baby boomer generation that still has another 20 years before they'll be looking for this space. But that said, if you look at the right MSAs around the country that are underserved, secondary markets, tertiary markets, we find significant demand still.
And so the peak demand for seniors housing, I did research a number of years ago for NIC on that, and it used to be that the average entry age into independent living was 78 years old, and our generation is healthier than my parents' generation. That's probably pushed out to 80 or a little bit beyond, so it is 15 years before we really hit peak demand there. In the student housing, as I said, we're going to start to see a slowdown in the growth rate of millennials coming out of college, which means that coming in as well as slowing down. It's still positive, it's just a little bit lower rate. And I would say, just from my experience at the University of Denver, that we saw a number of student housing going up when there were lots of other options in a major city like Denver. And so a lot of my grad students live downtown. We've got light rail, they can hop on light rail and be at school in 15 minutes. They'd rather live downtown and have a good time. So we literally had one of the first student housing projects that went up 5 years ago not work because they were trying to get downtown rents right next to the university. That went under, somebody else bought it, brought it to the correct rents, filled it up, no problem. So it is an extremely market-specific piece there, but so we're again seeing that sort of deceleration of growth in millennials. So you need to be picking your markets very carefully on the student housing side. In the general apartments, workforce housing is always going to be in heavy demand. I actually live in Mountains, Colorado, and we have an extreme shortage. If you can figure out how to put a reasonably priced rental units, come on out, because there is a huge demand for workforce for lower income. And as you all know, if you're doing low income housing, that just instantly fills. We've got friends that develop high-tech stuff, and there's a waiting list on everyone.
So do you foresee see the opportunity zones really assisting in kind of building that EC type property or that entry level property that's been so hard to come by, given the high property values currently and rising interest rates really pricing people out.
Yeah, and again, with my son selling off our single family home, looking at what to do, I was amazed at the size of the enterprise zone in Denver. It was much larger than I thought it was, so you all ought to take a look at the enterprise zone and see that we're working it, because the way you can bring in money, 1031 into things, and then eventually bring your basis up without paying any taxes at all is just an incredible opportunity.
Unintended.
Yeah, it's been interesting looking at the opportunity zone maps. Because we know the basis of the opportunity zone was, based on economically depressed areas with, lower than average median incomes as compared to the MSA. But some of the mapping seems to be a little bit untrue.
Yes.
And there's definitely, as you look at that mapping, opportunities to pick up locations, that one would argue, may or may not, qualify for the opportunity zone as it was originally intended.
Right.
So there's definitely some great opportunities to be had there.
And I think we touched on, a little bit about that workforce housing, but how has immigration reform's impact been on tenant occupancy and labor and affecting kind of the multifamily development? Anything to add on kind of that product that's really kind of missing in terms of multifamily?
We haven't seen any impact yet. I will say this, obviously, the rental community has a high, the immigrant community has a high importance in the rental community. Immigrants rent more than American-born citizens is a fact. The homeownership rate amongst Americans is roughly 60%, which is actually down. The homeownership rate amongst immigrants is roughly 50%. Now the interesting trend there is the homeownership rate amongst Americans is down from, let's say, 65 to 60. From the immigrant community, it's actually up. It was about 40% 15 years ago. So you're actually seeing a shift of immigrants starting to buy more homes than Americans are. But again, immigrants do rent more than Americans. So again, in our portfolio, we haven't seen it too much. That might be because we're in some markets where they're not border markets. If you go to certain markets in Texas or on the border, you probably see a bigger impact in California. But there is always going to be the importance of immigrants in the rental community, that's for sure.
On the workforce side and the labor side, we're definitely seeing the impact. Most of us, as we talk around the country, are seeing delays in project completions of anywhere from 1 quarter to 2 quarters. It's not atypical now to be, 90 days, 180 days late. And it's literally because the workforce can be just, if a lot of the workforce are piece workers that are working for your trade partners, and they're literally picking up and going down to the guy down the street because he's paying $100 more for that job. So that continues to be a big issue for us, is labor and the products.
I'll just add, we talk to a lot of home builders, and the immigrations had a definite impact on the cost of labor. Anecdotally, we've heard stories of builders having to provide lunch to their workers because if they went away for lunch, another builder down the street made closure. We actually heard a story where a builder let his crew go after lunch, and they never came back, and they were on their way up to, this was an Atlanta builder, they were on their way up to Nashville. The builder from Nashville came to Atlanta, and so we've seen definitely some significant impacts from labor, as kind of labor shortage in home building, as well as multifamily. It adds to the cost situation with the steel tariffs, lumber, all of that is added to the cost of home construction as well as apartment construction. And builders are reaching a point where they're not able to push
impacting their decisions. Student debt is, I think, something like 44 million Americans in student debt now. That's a big percentage. Student debt is, it's actually, it's a crisis. It really is. I think a lot of us forget about it, but ask people who are 21, 22, 25, 28, coming out of college or grad school, and they have 15,000, 30, 40,000 of student debt. I mean, they're not putting away anything in savings. It's good for the rental community because they're going to continue to rent, and they might be lifelong renters. They can't put away money for a down payment, and they get sucked into this life of having everything taken care of them for that maintenance and landscaping and whatnot. So that almost moves to the single family conversation, which is these millennials are going to be renters in their 20s and 30s, and they're going to get so comfortable with it, they might stay in that pool, and they might say, I don't want to have to worry about, paying my utility bill individually, I don't have to worry about landscaping, I don't have to worry about maintenance issues. I'll get someone to do it for me, the owner of the company. So, the millennials, I think, will really drive this apartment trend, and I think a lot of it is unfortunately because of student debt.
I 100% agree with your characterization of student loan debt payment prices. The big issue to me is the rising cost of education. The three big costs that I'm concerned about are number one, education, number two, healthcare, and number three, actually housing. And those costs have increased much faster than wage growth. To me, that's a formula that's not sustainable long term. But I will say that there's a distinction between people who have student loan debt that have a degree and people who don't. And so there are a whole lot of people that took out, since the recession, took out a whole lot of student loans to go back to school that didn't finish. Those individuals have a higher propensity for default and are not viable economically, whether for rents or buying houses. But typically, people who have student loan debt finish, long term they make more. They have higher incomes, and what we've seen is there's a correlation between student loan debt and home ownership because people who have a large amount of student loans theoretically make higher incomes long term, and so those are your primary buyers. But I do agree that I think it's a concern that no one's really appreciating because I think the good economy, low interest rates kind of shielded an issue, but it's not sustainable.
Now, it isn't as much as 50% of the people who have student loan debt do not have degrees.
I'm not sure.
Yeah,
it's a good.
I know it's significant. People, well-intended, and just never got to the finish line for a bunch of reasons. One of the things we were talking about with the millennials is, to the extent that they're not going to be home buyers, there's obviously a lot of baby boomers out there, that aren't going to, be finding the natural move-up buyers that will eventually then purchase their home. That's going to be another issue, over the next 20 years.
I will say, millennials eventually do get married, and they do have kids. And I never heard the but yeah, eventually they want to live in a single family house, and so either they will rent that house or they will buy it. If they buy it, one of the benefit, the impacts of millennials renting kind of Class A rentals is when they do buy a house, they want better fit finish in those houses. And they're waiting a little bit longer to buy. So instead of buying a $150,000 starter house, which doesn't exist anymore, they're buying a $300,000 house, $350,000 house as their first home, and it's a little bit different. So they are eventually going to buy. They're just going to buy later. They're going to buy more expensive.
Noah brought up some interesting thoughts about it. It does the millennial because they are used to the benefits of rental, not having to take care of things, just continue to transition into that mindset, as they form families as well. And one of the things that we continue to see with the millennials, as they're now, I guess the oldest millennials are in the 37, 38-year-old range, they are now forming families. They're now bad choices about schools and alike, and starting to have to make the decision about moving out of these urban core locations that may not have as good schools, and starting to look at locations, call it, whether it's a suburb location or a more suburban location, but something that has better schools. And so whether that's a rental alternative or a for sale alternative, eventually that dynamic comes into play. And we think that's going to continue to drive demand for suburban product, especially some of these alternative housing types like these higher density rental homes that we're talking about.
Right, thank you. So one last topic to cover. With the easing of our credit standards, how do you guys see the impact in terms of getting deals done or more sales in the environment, or what's going on in this stage of the market cycle?
As long as banks are willing to give people money, they will continue to buy. Regardless of the price and cap rates and yields, it'll continue to happen. I read a very scary article this morning. I don't know if you saw it. Bank of America issued $10 billion of subprime mortgage loans. $10 billion of subprime mortgage loans to borrowers who didn't have down payments, who were not qualified. I literally read it this morning and it shocked me. We all know what happens when subprime mortgage loans are issued, and obviously that's a single-family home community, but even in the apartment community, I know lenders are strict and you have to hit a DSCR coverage, but every year we see more and more debt being issued. Just between private bridge lenders offering high leverage loans, we've seen an increase of 100 lenders in the marketplace over the last year. 100 new lenders have come to the marketplace over the last year for high leverage loans. Now, there's nothing wrong with high leverage loans if the properties can support it and the borrowers can support it. But I don't know if there's an actual, I don't know if lenders are strict in any means. There's definitely an easing of credit standards. Again, if you borrow smart and you borrow leverage of 65–75%, there's not that big deal, you should be okay. But be careful if you're an investor, you're investing with a GP, or even if you're a lender, unless you're predatory, want to take those deals back. A lot of these deals might go south if one, occupancy rates don't stay at 95%, which they won't. And if two, rent growth doesn't stay at 6%, which it won't. We're already seeing markets like Austin. 6% rent growth was the norm 2 or 3 years ago. Now it's down to 2 or 3, which is good. I think it's good if you see 2 to 3% rent growth. That's a healthy market. Same with occupancy. We're starting to see occupancy get to the low 90s in certain markets that were 98% occupied. So you need to be careful. At the end of the day, you need to be confident that you can pay your lender because they're not very forgiving.
Yeah, so no, to your point, top news on Bloomberg today, B of A lending business gets jolt from rates, profits climb 32%. So those bankers are making money off of it, but
Scary.
where are we at? We have a short memory, huh?
Yeah, we're seeing that are being very aggressive. And we, like Noah pointed out, we tend to be fairly conservative. We look at a 65% loan to cost. We think that's an appropriate amount of debt, but the lenders, are not shy at all about trying to push you beyond that. They're very aggressive right now for money.
Well, working for a regulator, this kind of concerns me. So the most important measure that I look at as kind of leading indicator of where we are in the cycle is housing affordability. You can actually do the same thing for rents as well. And basically, this tells you what the median income household can afford given the median cost of the house as well as the current interest rate. We've seen a rapid decline in housing affordability as rates begin to increase, and that's normally a leading indicator that we're nearing the end, that the cycle is at least experiencing some stress. And so the second shoe to drop is losing of credit. And when you see the combination of decline in housing affordability, we've seen a decline in home sales, we've seen a decline in occupancy, we've seen slower rent rates, and you're seeing losing of credit. Those are indications to us that the market is at least stressed and near the end of the cycle. But a broader issue to me, which I think underscores everything we talk about is the cost has increased from the development side as well as the cost that's been pushed off to the renter and buyer much faster than wages have increased. And over time, particularly as rates begin to rise, that's not a sustainable formula. The bigger issue is, can we, if the buyer needs to move down, if the renter needs to move down to a cheaper price point, are we able to deliver a cheaper product? My big concern is, since this recovery, we no longer have the ability to build true entry-level product. I was having a conversation with a lender from Miami who was excited about how the entry-level market in Miami was so strong for single-family housing. And I asked him, what exactly is entry-level? And he said, well, $500,000. I said, no, it's not. That's not traditionally what we think of entry, but that's the cheapest product that a single-family builder can build in that market, and that's concerning. And that's not just Miami; that's markets across the country. It seems like we can't deliver new home product below $250,000. I think that that actually benefits the rental market more. Maybe long term we have less home ownership because we just can't deliver a cheaper product.
And that's been a focus of ours across the country. As we look at secondary and tertiary markets, we target rents at 30% of the median income of the MSA. We think that's a viable place to be from an investment perspective for you.
And just on the construction side, since University of Denver is the only place that's got real estate and construction management in the school of business, one of the things that we're seeing, a former student went out and started doing modular, called them I units, 450 square feet apiece, and he did a 40-unit project that really went up in 3 days. Got the foundation and everything else, income, all the units crammed in place, 3 days and they're all up, down, button tie up, do all that kind of stuff. And so delivering at a price point that he is now focused on workforce housing because, when we're talking about building at $110 a square foot versus everybody else in the marketplace is at $300. So I think that is one of the things that's going to make it possible for that kind of thing to happen.
Great. Looks like we're out of time, so if you do have any questions for our esteemed panelists, please catch them during the conference. So thank you so much, Jim, Noah, Dominic, and Glenn. Appreciate your time.